Hello and good day. This presentation outlines our training materials introducing value at risk for investments including funds and portfolios. So if you wish to improve or refresh your knowledge of risk measurement methods and value at risk, perhaps we can help. Welcome to our training course on introducing value at risk. Value at risk is a way of quantifying risk. So we want to put numbers to portfolio risks. If you like, the challenge is to measure risk. If we are to measure risk, we must define it. In this case, mathematically. Perhaps it is something to do with the variability in returns. Isolated quantitative measures of risk tend to have weaknesses, because ultimately risk is hard to define. This also applies to value at risk. Value at risk needs to be properly understood so that its limitations are appreciated. The emphasis is on the uncertainty in returns, losses, probabilities, magnitudes of adverse outcomes, and relationships between assets. In this course, we focus on how to calculate value at risk, not the regulatory aspects which are not covered. This course is intended for professionals in the finance and related sectors. Also for staff with continuous professional development requirements, individuals studying for exams, and it should help individuals seeking to better understand methods used to measure risk, to understand the concepts behind value at risk, and to appreciate and implement value at risk calculations. The content is pitched at an intermediate level, so from a mathematical point of view, an understanding of summation is required, and also a small degree of comfort with matrix operations. Here we see the course outline. We start with an introduction and then ask what is value at risk. Next we look at volatility, and then the VAR statement and basic parametric value at risk. That's followed by basic value at risk methods. After that, we look at parametric value at risk with many assets and how we might improve parametric VAR. Thereafter, we turn to how we might improve historical value at risk, and for more complex scenarios, we look at Monte Carlo simulation value at risk. Finally, there is a summary. Reviewing the content of the course, in the introduction, we think a little about risk and uncertainty. When we ask what is VAR, we also include a definition. For volatility, we consider the variability in returns and the normal distribution. The VAR statement is very important so that you can correctly interpret comments that are made on VAR when you see them. We also consider how you would convert between different value at risk values. For parametric value at risk with many assets, this allows us to consider portfolios. But there's also a problem in that we must think about non-normally distributed returns, in which case we have to improve parametric value at risk. We can also use historical VAR, depending on historical data, to calculate our value at risk. Monte Carlo simulation allows us to consider more complex assets such as call options or other options. In this course, you will see simple worked examples illustrating key concepts, including probabilities and the normal distribution, non-normal distributions and how these impact value at risk calculations, historical value at risk, using correlations for parametric value at risk calculations on portfolios of many assets, historical simulation value at risk, Monte Carlo simulation value at risk with randomly generated stock price paths, and how it can be used with non-normal distributions. This course also brings you innovative training materials such as a video animation to illustrate the concepts of skew and kurtosis, making them more memorable. In this course, we have covered a great deal of material on the subject of value at risk. An overview of the topics covered includes what is value at risk, volatility and the normal distribution. We also looked at the VAR statement and basic parametric VAR, parametric VAR assumptions, non-normality and historical VAR. After that, parametric VAR was extended to a portfolio of many assets using correlations. There was a concern about non-normally distributed returns, how to deal with skew and kurtosis, which led to Cornish-Fisher VAR or semi-parametric VAR, as well as historical simulation VAR, an improvement to historical VAR. Finally, we introduced Monte Carlo simulation VAR, which simulated stock price charts, different return distributions, and the VAR of a call option. If you think this might be of interest to you, and we may be able to arrange training or individual mentoring for you, please do not hesitate to contact us at Fort Grey Consulting. Thank you for your time and have a good day.